Hello, Uncle Jim here. Today I want to share with you one of the greatest ways to make passive income on a monthly basis, and that's selling options. I've been doing it for a long time, and I've been able to kind of stay steady with what I earn. I'm going to share with you how I do that, and I'm also going to talk about my trades from last month. I'm going to actually share with you my June trade, so stay tuned. I think you're really going to enjoy what I have for you. Okay, now let's go ahead and jump in. I do like to begin most of my videos with kind of my take on what's going on in the market. We are kind of in a bull market, especially with the NASDAQ, and we've reached, I believe, a 20% increase, or we're 20% above where we were compared to the lows last October. Do I think we're in a long-term bull market? I don't think so. I think we're still have a little bit more pain to go through maybe in later this summer or early fall. But I do think at some point we will truly be in a full-blown bull market. It's been a really good week. We've had, I think every day has been up. Today, this is Thursday, and I believe we're up today too. It's Thursday, July 13th, and it's weird. I keep saying it to my members, at the end of the week or when I'm getting ready to begin a week. I said this week will be up. Last week I said we would be down. No science here. I'm just saying, kind of reversing the trend from the week before, which has probably been more luck than anything else. If that's the case, then we're probably going to have a down week next week. But I'm not so sure. I do know there's a lot of contrarian views of the current market. A lot of people who are kind of negative, even though we may be in a kind of a short-term bull market. There is a little bit of headwinds earnings-wise. I believe earnings are projected to be down probably close to 7% compared to the last quarter. And we do have the, we do have the inverted curve yield curve, which has been that way for a long time. And I do believe part of that's because long-term people are thinking rates are going to come down, and I do too. But I don't think they will ever reach the levels they did back, right around COVID time and even before COVID. I think we've had unusually low rates for a really long time. I think we will come down a bit, but I don't think we'll ever get down to those lows. And I do think, unfortunately, the Fed's probably going to increase rates at the end of this month. But the consensus now is the September meeting, they probably will hold steady again and not increase the rates. And that's kind of what the markets are showing us. We're seeing, unemployment is staying low, but we are seeing signs that inflation is coming down. And it takes a long time for it to come down. So I do think at some point, they've hit a point where they're increasing too much, and I think going forward, we won't see anything more than a quarter point. And I do think they will hold steady in September and maybe actually even start decreasing later in the year, maybe late this year, early next. At least that's my take, my 2 cents, and it's probably only worth 2 cents. Now let's go ahead and jump into the main part of this video. And I'd like to start it off by meaning part of the reason I'm successful is I stick to guidelines, I stick to goals, I stick to kind of a very basic plan, and I don't allow the squirrel syndrome to occur, meaning, oh, squirrel, let me try something different. I take what works. I like to make small modifications. I call them my guidelines, what kind of deltas I use. And I, for the most part, stick to that. On occasion, and I'll talk more about that later in this video, I will change that guideline a little bit, or I may make more modifications, but I don't ever do anything that's significant. And I also like to set goals weekly and monthly. My goal weekly is typically to try to make 1,000 a month, of 1,000 a week, and then monthly 4,000 a month. But I don't always do that. Last week I think I did only $550 or something like that. This week I'm already over 1,000, and I'm all I'm selling is covered calls. And then who knows what next week will be. So these are averages, and I do like to try to trade, at least one trade a day, and try to make as much, as close to $100 per contract. And I typically do 2 contracts, so I try to do 200 a day. Last week I did a lot less, mainly because I didn't trade on Monday and Tuesday because of the 4th of July. The markets closed earlier on Monday, and of course they weren't open on Tuesday. And that's happens a lot during the summer. I believe it also happened in June. June, I think I did 3,600 for the month, slightly above 3,600, and there were a couple days just like that. I believe Memorial Day, the markets were closed. There may have been one other day, maybe that June 16th holiday they have. I believe the markets were closed that day too. So to me, just sticking to a goal, trying to do one trade a day, and then since I'm still working, I'll do that trade, get off the market. I'm typically not on the market that much. And that's where my difference is. That's why it's worked for me. I don't constantly look at, different, more complex types of trades. I will try, and I've said this in previous videos, I may try to do one a quarter. This month I did a iron condor. Now I've done iron condors before, but I did it, I haven't done one in a while, and I did it on IWM, and it's fairly a safe trade, and so far it's working out quite well. So that's kind of, for me, what works, the slow and steady, not get rich quick. If you can make $200 on one trade or close to 200, usually for me it's between 150 to 225 on each trade, but if you're going to do some other type, drive for Uber or do Uber Eats or, some other passive income side hustle, it would be hard to match that. It takes me 20, 30 minutes to do a trade. Not even that, sometimes only 10 or 15. It takes me longer because I share my trades with my memberships. So it takes me a little longer to get everything together and to post it for my memberships. And as always, if you want to take a look at my memberships, details will be below. And as always, please subscribe, hit that like button. I really want to get the word out that you can do quite well selling options, and it can really, be the difference between having a rough retirement and a good retirement, and actually being financially independent a lot sooner than you ever thought possible. So next I want to talk about some changes I'm making to the strategy I was just talking about, to my guidelines. Now, I am going to look for some growth companies to add. I typically have been looking at value companies. I want to add one or two, a couple of growth companies. So I'm going to look at those. I still, I won't invest in companies that aren't making money. So I want them to be making money. I also want them to be, growing, but not be outrageously expensive. A few of the ones I've looked at recently have gone through the roof. And part of this is because they do pay a lot more because of the volatility. The premium option wise is typically a little bit better, or a lot better, compared to value companies. Some of my value companies don't pay much premium at all. Great examples are AT&T and Verizon, both of which I own, but there's been very little premium with them. And they're so low. I believe they've been oversold. And I do think they will have a rebound at some point, but they seem to just kind of, I think AT&T is in the $15 range, and it's been struggling. So I'm going to look for some companies that are growth companies. My hope is to get, a company like an Apple before it's had the crazy growth. At least that's what I'm hoping to do. And as always, I'll share that with my memberships as I identify it. Or if my members share stuff with me, I'm going to post their ideas and what they think, to share for the whole community. So that's one thing I'm going to change. Typically, I've been looking at value companies that pay dividends, so I will add a little twist for finding some good growth companies. The other thing I'm going to do is I do have some companies and ETFs that I really don't want to own anymore. An example is Big Lots. So I'm looking to sell it before the end of the year. So I'm selling covered calls on it pretty much right at the money or slightly above it, so I can really generate some cash. Until that point, I'm ready to sell it. Another example is an ETF, STY, which is a good ETF, but it's not my favorite. I prefer SCHD or DVY, which are two other ETFs that have better returns and pay better dividends. So I'm looking at moving that over, getting rid of STY and picking up SCHD or DVY. And while I'm doing that, I'm actually going to sell much higher risk or higher delta covered calls to bring in a lot more cash. And then if they get called away, that's great, because then I'm just going to go ahead and start selling puts again on either DVY or SCHD. My preference is SCHD. It's my favorite. It pays, I think, around a 3.5% dividend, and it consists of all good dividend growing companies that I really like. So that's one thing I'm looking at. That's a main reason why you might take more risk than typical. Another reason might be if you have a stock, like I've been looking at BKE for a long time and I really want to own it now. Buckle has no debt, it pays a good dividend, and every once in a while it does this special dividend that usually is significant. It almost doubles their current dividend. So I do want to own them, and I would probably do it as a cash secure put. And it's getting pretty near its 52-week low. So I might also take a little bit more risk with, owning a company like BKE. So those are instances, again, where you might change your guidelines or your strategy on how you do things. And that's something I'm looking at. So I'm definitely taking that under consideration. Also might do different, especially deltas or risk levels for different types of assets. I find ETFs don't move as much, which makes sense. So I don't know that I should be applying the same delta for an ETF that I am for, a put on a company. So I'm also going to look at that. I probably will take a little bit more risk with ETFs, again, because they don't move as much, and probably less risk on the company I just talked about, or a type of company I just talked about, a growth company. I'll probably take a little less risk because they have the potential of shooting through the roof price-wise, or in the reverse, dropping like a brick. So, and then one other important guideline I wanted to mention recently is I had always talked about rolling puts when the market's down and rolling calls when the market's up. Now, that's not always true. I found some good premium recently when a stock, I can't remember which one it was. It might have been IWM, but I found that I could roll it, and it was a put on an up day, and I did fairly well. And I believe that the case for that is the fact that the cost of closing it was less, so it outdid the potential higher premium for the put that you'd be, selling. So I think that also will change in my guidelines and standards. I don't think you should necessarily not look at rolling specific securities just because the market's down or up. So I'm looking more often at opportunities to roll, especially if it's in the money or it's very, very profitable. Again, I like this to roll if something is, above 70% profitable, 80% profitable, within reason, because your profitability can be impacted. If you've rolled something in the past and it's deep in the money, then that number could be thrown off. It might show 90% profitable, but it may still be $100 to close it. And it may be expiring next week fairly outside the money. So in that case, you would not, close it early or roll it at that time. So again, the guidelines kind of work, you have to kind of have common sense related to it. Don't always stick to a specific guideline. Overall kind of work it a little bit, but not significantly. Like I don't plan to go too far away from my 15 delta for puts and my 20 delta for calls. If I change it by asset type, I may do a 25 delta for calls and a 20 delta for puts. I'm still going to keep it pretty close to that, that level, unless, again, if I want to get rid of a specific stock or ETF. So I just wanted to add that because I had said before, that you shouldn't roll unless the market was down, and calls unless the market's up. But that's not necessarily the case. I just wanted to share that. I found I've been able to roll and do fairly well when the reverse is happening, when a stock that I have a put on, the stock goes up, and vice versa. When I have a call, the stock or ETF goes down. So just wanted to share that, some ideas I have related to changing my guidelines or strategies. I'd be curious to what you think. Leave a comment below. I'd love to hear, if you have a different strategy or something that's worked really well for you, please share in the comments. I typically answer all my comments. Again, I'm a small channel. I'm still growing. So with that being said, let's jump into the next part of the video where I'll share my June trades. Thank you. Okay, now I've opened up my June spreadsheet. This is a spreadsheet I created just to kind of show all my trades in one place. I typically have planning worksheets each week, so what I did is I went back through each of those planning worksheets and just combined the June trades. So these aren't in any particular order, but overall I did 3,600. You can see June premium, which has been a little bit lower than recent months. I believe I did the previous 2 months, April and May, I believe I did 4,000, over 4,000 for both of those months. This is the amount of capital I needed for the trades, and it's just a summary of the required capital in this column. Then overall I did like a 5% based on that capital. Now, I don't know if this is a good calculation, but it's just literally the income, the 3604 divided into the 74,541 or 641. And that was a 5% return. And if you did that on a yearly basis, it would be almost a 60% return, which, a lot of these are covered calls. So it's just another way of showing it. It's not like I did 5% for June, because if you look at my overall asset value in the different accounts, it was higher. I probably did closer to 1%, maybe not even 1%, maybe like 0.8% or something like that. So just for instance, I've talked about in other videos how you can do anywhere from 1 to 3%, but it's actually up to 3%. For me, I've rarely done above 3%. I may have had 4% month, and that's based on all my assets within those accounts. These aren't accounts that I created just for option selling. These are accounts I've had for many years and I've been trading in since the 80s. So a lot of these stocks have really low cost basis, again, because I've owned them for so long. So just wanted to kind of share that a little bit just so I didn't confuse people. And again, here's my weekly goals: 130 weekly and 4,000 monthly. Again, I try to do one trade a day. So let's actually kind of go through the trade. So Schwab, again, I really like Schwab. They've been hit hard because of the banking crisis, and they were trading in the 80s. So I did a vertical put credit spread, 55.45. For a long time, it was in the money. Now it's out of the money. This current price was back in June, but it's currently, I believe, 57, 58, something like that. And I rolled it. I kept it at the same strikes. I picked up 218 in premium. The required capital was 1781, and again, that's because of two spreads. So two $10 spreads is 2,000 minus whatever premium you brought in, and that's minus the 218.80. That's how I came up with 1781, and it's like a 39% yearly return. And that, again, that's assuming that it just expires. If it expired, that's what the return I would earn. Now, I've had people say, well, you can't really do it that way. You need to wait till it closes. But what I found is, and with most of these trades, I do close them early. So I probably will close it before 10:20 or roll it, which in a sense is also closing it. So the return, when I've gone back and I've looked, has actually been higher. Of course, that changes. It can go the other way, and it could be assigned to me. And I've had that happen too. But a lot of those stocks, other than I think Big Lots and Lumen and maybe ARC, there's only a few that are below what I paid. So next is Ford. Ford, I sold a cover call at 16, expiring on 12/15. I brought in 185. Now there were three contracts. Brought in 185. That was like a 9% return, again, based on the cost basis of those shares. So that was a cover call. I did I did about 7 covered calls in June, so I didn't do as much. Here's IWM. This was a vertical put credit spread. I rolled it. It was 168, 158, and I rolled it. Somehow I'm missing the numbers over here, but I rolled it, I believe, at the same. This one actually might have been new, 168, 158. I brought in 166. No, it is also one I closed. Somehow when I transposed these numbers, I lost these. But I believe I rolled it out to September 15th. But I brought 166 in. This was like a 29% return because of the expiration. It might have been all the way out to October. But IWM, I've done quite well with it. None have been assigned to me, and actually I've been able to roll them every time or close them. WBD, this is, I believe, Warner Brothers. This was, I believe that's Warner Brothers. Is it a cover call? Yeah, it's Warner Brothers. It's AT&T. It was part of AT&T. They diversified out of it, so I ended up with those shares. I don't really want to keep it, so I'm selling covered calls that are pretty near in the money and trying to bring in a bunch of cash. I plan to sell it at the end of the year. It also, since they provided it or diversified it, it's like down 50%. So it's another one I'm going to take a loss with, but I never made the choice with buying that. So, but I will take the loss against other gains. But it's like a 10% return. And again, I brought in $82. It's only one contract, and I believe when was it expiring? 10/20. So I probably won't roll it again. I'll probably let this one expire, or if it gets assigned, that's okay, again, because I want to get rid of it. And then at that point, I'll probably look at selling it and taking the loss and bringing the cash in and putting it someplace else. So next is Devon. Devon is, I believe it just recently got out of the money. It's been kind of skirting in the money the whole time. It's a vertical put credit spread. I rolled it with 50/40, and I've done a lot of contracts at this range, 50/40. I rolled it from 721 to 915. Kept the strikes the same. I picked up $162, and I believe, when was the expiration? 915. So 37% return. So not bad. Devon has worked out well. It's not an expensive stock, and it does pay a nice dividend too, I believe. So I've done a lot of trades with it. Next is one of my favorites, which is, I keep wanting to say Washington Mutual, but it's not. Williams-Sonoma. I don't know why I had that on my brain. I guess, owned some of them a long time ago. But this is a new trade, 165 or 105.95, 14 delta, so a very low delta. And the price at the time was $122, and I brought in $149, and that's like a 49% return because it was expiring in 8/18. So it wasn't a whole lot of days. 50, I think that's 59 days. So literally 2 months. So that's why the return is so high. And again, Williams-Sonoma, no debt, pays a nice dividend, well-run company. They are being, things are a little bit rough right now because of the economy. People aren't spending as much money in retail stores. But with Bed Bath & Beyond going out of business, I think they're going to continue to do well. And I know a lot of people buy stuff online. I do as well, but I still like going into Williams-Sonoma. It's one of my favorite stores. Next is a Coke trade I did. I end up rolling a lot of my Coke options that I already have. So I rolled these. These are covered calls, 3 of them. They were 70. I don't know why I have an outer strike. There was no outer strike on that. So a $70 covered call expiring on 12/15/23, so still quite a ways out. I rolled it to 6/21/24, so I rolled it 6 months. And again, I own a lot of Coca-Cola. I inherited it as a child. I don't plan on selling it. I'm going to pass it to my son. Mainly because the cost basis is crazy low. I think my grandfather gave it to me when I was 16 years old. and I've kept it ever since. I have sold some along, to pay bills off and maybe to help with, buying a house and things like that. But for the most part, I kept it all. But I brought in $260, which isn't bad. The return is real low, 3.3%, but that's still higher than the dividend that Koch pays. Koch pays around a 3% dividend. And here you can see with the low cost basis, that also helps. Actually, this is probably should be lower. I'm not sure what cost basis I'm using. What is it, $26? That may be correct. I continue to earn or bring in more shares of Coca-Cola through their dividend reinvestment plan. So that's why that may be 26. Some of my original shares are like $4 or $5. So, and you can see this is an unusual trade. I rolled it from 12/15/2023 to 6/21/24, and at the time it was like 85% profitable. So again, I like to look at my summary page on Schwab and then sort them by profitability. And this is one I found on a particular day, and I was like, wow, I can do pretty well with that. And there's literally no risk. It's still significantly outside the money. I believe Coke actually went down. I think Coke is below 61 currently. Next is Square. This is another, for instance, I talked about wanting to own some growth companies. This is one of the first ones that I decided to do. It's a vertical put credit spread, 52.50, 42.50 for the outer put I purchased, expiring in 8/18. So again, not as long an expiration. At the time, it was 64.15 was its current price. So, and I believe it's higher now. It may be into the 70s now or close to 70. But I brought in $149. And again, was that only one contract? That should be 1,700. Yeah, that should be 1,700. So this is a little bit high. That's a mistake on my part. But still, unless, no, it was two contracts. So you can see how well that did. That's one of my best. And that's my best trades were the ones in green. So this was one of my best trades, but I do this. This is incorrect. Should be half that. So it's like, again, 47 or 48%. And this should be nearly 300, and this should be 1,700. I made a mistake with those calculations. Next one was Ford. Again, I'd sold a covered call, 3 contracts. I have Ford in 2 different accounts, one of my retirement accounts as well as one of my brokerages. And so it's a covered call expiring on 12/15. Current price of Ford at the time was $14.35. Brought in $139, which isn't as much as I like to get typically, but again, with a $15 stock, that's not bad. And it's like a 7.5% return, yearly return. Now, one thing about my covered calls, one of my goals is to double my dividends. So if a stock is paying 3 to 4% in dividends, I'd like to get at least a 6 to 8% return yearly for covered calls. So I handle covered calls a little bit different. They're less profitable in my mind compared to vertical put credit spreads, and definitely probably more comparable with cash secured puts, because you're definitely taking more risk with a cash secured put. You're not buying that put where you're protected on the downside. So next is IWM, again, Russell 2000. This is one of the ones I trade just to make cash. This was an iron condor. I decided to try an iron condor with an ETF. I believe in the past, whenever I did an iron condor, it was either with Coca-Cola. It was not with an ETF. So I'm playing with the idea, is an iron condor going to work better with an ETF than a stock? And this one's doing quite well. It's actually approaching the 200 range for IWM. So it may be I may have to roll it up and out potentially, but right now it's still very profitable, and it's still fairly far away from the 207. This was a 12 delta. So, and this is, in my mind, pretty safe trade, 207 to 217. And 169 for the low and 207 are the two that I sold. And it's right, that's pretty close to the price it is right now, 188. I believe it might be 189 or 190 now. So I brought in 111. Again, this is for one contract. And because it's so short, it has a higher return. And again, I verified these numbers when I actually did the trade. So the required capital for doing it was 888. So in a sense, I could have done 2 or 3 contracts and I would have done it even better. And a 70% return was probably my best trade for June. So again, an iron condor using IWM may be a really good strategy to use. Next is GLW, another one of my favorite companies. This is Corning, and this is a covered call, 37. At the time, it was 33. I believe they've gone up to 35 now. I brought in 178, and it's like a 6.3% return, yearly return. So definitely more than doubling the dividend on GLW. So almost tripling it. So, mainly because Corning's current dividend, I believe, is right around 3%. So if you don't have Corning, it's something you should look at. It trades in a very narrow range, typically has fairly good premium, and it's a fairly safe stock to trade with. I really like them. Next is QCOM or Qualcomm, and I rolled it, vertical put credit spread. At one point, it was $4 or $5 in the money. Now I believe it's significantly out of the money, 110 to 100. And somehow I've lost my numbers again here, but I believe I rolled it out to, let's look at, unless this was a new trade. I might have put roll in there by accident. This might have been a new trade, 110 to 100. Yeah, this was a new trade. So 206, and then this is the required capital, and it's like a 46% return. So I don't know. I'm not sure about this trade. I might have forgotten some information in here. I believe I did miss a roll, usually for the calculation. It was 91 days out. So yeah, this must be, I rolled it from July to probably October. So that's why it's a 46% return. So yeah, I'm missing the expiration and I believe I stuck to 110, 100, and I believe this was probably, if it was 90 days out from then, it was June, July, August, September. So probably September 15th is what I rolled it to. Sorry about that, guys. I didn't realize I made that mistake. So I'm going to try to go through these next ones. Best Buy, I've been rolling it. I've had this same contract for a long time, 72.50, 62.50. It was in the money. Now it's out of the money. And I lowered it a little bit at the time. I rolled it to 9.15 and lowered the strikes from 70 to 60, brought in 222. Required capital, 1776. And this was a 45% return. So I've done pretty well with Best Buy. It's been a really good trade for me. And again, it did, at the time when I rolled this, it was in the money. So now I believe it's in the 80s or close to the 80s. XLE, another great ETF that I like to use. This is the energy or the, it's an energy related ETF. It has like Exxon Mobil and Chevron all in one. And I rolled this 79.69. It was pretty close to being in the money, 79.90, and I lowered it. Just went down $1, 78.68, brought in 204. This required capital 17.95, and it was close to a 60% return. So XLE is another great stock. It's worked, or not stock, ETF. It's worked out well for me. This is probably my 4th or 5th trade with it. Next is VLO. This is an energy company that I decided to try this in June for the first time. So this is one of my newer trades. That I haven't been doing it for a long time, but I rolled it. It originally was expiring on 6/16, 105.95. I lowered the strikes to 190. New expiration 9/15, and brought in some really good premiums. VLO's worked out really well for me. And again, a 53% return, which is one of my better returns. So that, if you're new to my channel or you've been watching my videos for a long time, you probably have never seen me trade VLO. It's one of my newer stocks that I've been interested in. They pay a good dividend, and they're well run. I believe they've got not a whole lot of debt. So again, another company to look at. IWM, this is another roll, vertical put credit spread, 163, 153. It was expiring on 6/16, rolled it to 9/15, same strikes, brought in 190, and it was like a 37% return. So again, IWM, can't say enough about it. It's worked out quite well. SCHD, one of my favorite ETFs, my dividend growing ETF. This was a new one. I covered call on shares I already own. It was 2 contracts on my 200 shares, expiring on 10/20. Currently, it was at 71.49. I believe it's approaching 73 currently, but I brought in 138. This is the cost basis, and it's a 4.4% return, which again more than doubles its current dividend of, I think, 3.6 or 3.5%, something like that. Nexus BMY. This is one of my only trades that's currently in the money. I believe they're right around 62.5 to 63 currently, but I rolled them. Kept the same strikes from 6/15 to 9/15. Brought in another 176. I think I brought in close to $1.50 to $2. So even if they were assigned to me currently, I'd still probably broke even with them. And this is a 33% return. So, and like I said, this is currently, I think I have only 3 or 4 stocks that are in the money, and BMY, maybe my only put that's currently in the money. Now, IJR is another ETF that I really like. I can't remember if it may also be related to the Russell 2000 or the S&P 500, but I believe it may be value companies, like mid-tier value companies. And it does pretty well. It pays an okay dividend, like 2.5, 2.6, but it's had really good performance. And I rolled a cover call on it, 107, expiring on 8/18, and rolled it. Again, I somehow missed the date here. Let's see how many days out. It's 168, so I think I must have rolled it out to maybe December or November. And I lowered the strike from 107 to 105. I believe it had dropped quite a bit, so at 96.74. When I had done the original trade, it was, I believe, in the low, might have been like 101. And it's gone up since then. I believe it's right 102, 103 currently. And it was a 4.2% return, which worked out quite well. Again, trying to double my dividends for either stocks that I own or ETFs that I own. So here's a breakdown. I did 7 covered calls. I did no cash secured puts. I did 12 vertical put credit spreads for a total of 19 trades. So again, you could see the 1 trade a day, sticking to steady, trying to make 200 on each trade and around 1,000 a week. It worked out well for me. And again, these were my goals at the beginning of the year. So being able to reach them midway through the year, I may try to increase them again. But right now, this works out fairly well for me. I'm not taking too much risk. I don't think I've had an assignment for a long time. Now, of all the 19, 12 were rolls and 7 were new, which I find interesting. So I'm still rolling most of my trades. It works out well for me. So that's it. Those were my trades. Again, I did 3604. And again, a lot of it, the reason it's less than the previous month is there were days that were closed. And just because of summer, it seems I'm a lot busier. So I hope you enjoyed that. As always, if I miss something in the spreadsheet or you don't understand, please leave a comment. I do share these spreadsheets with my memberships. This is something I will post so my members can have access to it directly. So I hope you enjoyed that. Thanks for joining me, and have a great day.